Welcome back, everybody. Your typical bull here, and today we're going to talk about my favorite style of trading, and that is supply and demand. Before we get into it, though, please do smash that subscribe button and leave your comments and hit the like button. Your support really helps the channel to grow, and it is very much appreciated. So this is kind of a near and dear trading strategy to me. It basically is really kind of my bread and butter, really. It started very simply, right? So basically what it started as for me was just a simple sort of, horizontal support and resistance style of trading, right? Like, okay, so I see this is a support level and I see we're bouncing from a support level, so okay, I buy, my stops are below support. That's basically kind of where this started for me, right? And then that evolved into this style of trading as I grew and learned more. So, okay, let's get right into it. So with supply and demand trading, there are only 4 types of setups. Only 4. And basically, really only 2 types of setups, but they're reversed, right? So what you get is the first type, you have a decline into a base, right? So you have a basing candle into a strong rally. So what is expected is that when price returns to that demand level and retest it, that there are unfilled orders at this location, and when those orders fill, you are going to get another rally, right? So the general premise behind that first setup is you wait for a reaction from demand in the form of these long wicking candles or some kind of a bullish candle, right? And you get that here. It's a pin bar V-shaped reversal pattern, 3 candle reversals, and what you end up getting is a trade. If we were just strictly off of the daily chart and you're trading from close, right, you would end up with an entry here. So this is the risk below demand. Let's just color that red. And then the target, of course, is this previous market structure high, if you see it up there, and that's the reward, right? So that's the trade. That's the first setup in supply and demand, and it's the same with any ticker. But we're going to talk specifically about day trading, right? So I'm going to first go over the setups, and then we will transfer this into more of a day trading kind of mindset, right? So the second setup, same thing in reverse, a strong rally into a base. This is the basing candle of a strong rally, and then as that price is retested and you get a bearish reaction from those levels, short trade to previous structures. So basically that's the first setup, right? And then the second setup, what you get, you're looking for a strong rally into a base into another strong rally, which is this here, right? So you get this strong rally into this base here. There's a base, and then there's another, arguably another base here, right? So in this case, there's a base here, but if you notice, this doesn't work out quite perfectly, right? You don't get, see, you don't get that reaction until the next day, right? And it does call for some adjustments, right? So if you had marked out this base this first day that this actually retests this level, you get a very bearish close, right? And then the next day you get this huge bullish candle. So you could get in there for sure. Or you could be more conservative here and say, okay, I'm going to wait and see what happens tomorrow. You might miss the trade, but what you end up getting is a retest of this level here as well. And then you can take this trade the same as normal, right? And then, of course, targets are previous structure highs here, right? So that's the second type of setup, or the third setup if you're looking at it really. And then, of course, the exact same setup is in reverse. You look for a strong decline into a base. This candle right here is a basing candle where buyers and sellers are in agreement on price, and then you look for another steep decline, and then of course you rally back to this. You get a bearish reaction here twice, and then previous structure lows as target. Okay, so those are the 4 setups. You have a rally into a base into a decline, a decline into a base into a rally into a base into another rally, and then a decline into a base into another decline. So that's it. It's only 4 types of setups, right? So how do we take day trades based off of this, right? So right now, strictly looking at recent price action, I'm on a daily chart. We have some important levels here, and we need to mark these out, right? So this is a very strong decline from this base at top here. So let's mark that. I'll make it red. That is, red for down, right? And then we have a very, very strong rally from this location on the daily chart as well. These are both untested levels of price action. So those are going to make good supply and demand zones. This level here, you may be thinking, okay, cool, that is a demand zone, right? But not necessarily, right? So, and the reason for that is you draw this demand zone here at this base, right? What you get is this price action here that trades straight through that. So what that means is that those unfilled orders and those areas of actual demand that you're looking for, when you get to this area and you find no demand, that means that this zone is not valid. You trade straight through it. And then this following day you get a bullish, super bullish candle on huge volume. So that is going to create new demand below this previous structure. So this level was valid up to this point, and you might even argue that you would have taken that trade off of that indecision candle there, but you would have gotten stopped out. It's not a big deal. You get stopped out sometimes. It happens, right? So now these are the 2 levels we have based on our daily charts, right? So now what we'll do is we'll scale down to an hourly chart, and the only indicator that I have right now is VWAP. Right, it's the only indicator on my chart. You don't even need that really if you're trading this way. Okay, now we have some more levels to look at, okay? So now, based on our hourly chart, we see we have a very strong rally that started from this location. This is the base of that strong rally. Okay, so I'm going to make this one a different color green. Let's make this one this darker color green. So now we know that this is from the daily chart, this is from the hourly chart, right? And we also see that we have a very strong decline from this candle here. Strong rally into a basing candle into a strong decline. So what we get is another possible supply level here. And then if you're looking again, you have another decline into this base into an extremely strong sell-off right here. This whole hour, nothing but selling. So that is another hourly level. That's important. Right there, mark out the base of that. Alright, so now we have a couple of more hourly levels. So let's make both of these this lighter, I don't know, pink, orange, rust color maybe, I guess. Okay, now let's go down to a 15-minute chart. You can use a 30-minute chart as well, but I find that going straight to a 15 from there keeps things a little cleaner. And now these, we only want very recent levels, right? So very recent levels, anything below the hourly chart. Hourly levels, daily levels are going to be the most important and most significant. But from our 15-minute chart, we can just mark out a couple of key pivots here, right? So we see that we had a strong rally into a strong decline at this location. So this will probably actually look a little better on a 5-minute chart even from yesterday. Right there, you see this pivot is where that strong rally, or that strong rally ended, right? So this would be this level here. There's the base. This candle right here is the base of that. And I'm not marking out all of the price action. I'm very conservative, right? So I'm just going to mark out the bottom of this price action, or the top of it in this case, right? And there's the hourly demand, right? So now what we get is another level that could possibly be important. So let's just make this one gray because we know it's not going to be as significant as the others, so we'll mark that as gray. Alright, this level here would be a very significant level. Okay, so now what happens is we have these levels. So now we know where we can base our high probability trades, right? So if we open up here and rally into this location and start to reject that location, we can take a low risk, high probability trade based on this. We can take a stop loss here and an entry here, and then let's say we create a market range, like a low range here, right? Now what we can do is use these pivots that are created in the last day or the last market to take our targets, right? Same as everything else, we have low risk, high reward. So this is the trade, right? So now let's go look at some actual past examples. So right here on our hourly chart, we see that this day right here, let me adjust that just a bit to get the bottom of that wick in. This day we started an extremely strong rally. Now, from a strict day trading perspective, you're going to be looking at a 5-minute or a 1-minute chart, right? And this day, we created a very strong decline. So now, if we're watching this at an open from the start of this rally, which is back here, that's where the very strong rally started, which is about 2 or 3 days ago, right? So now, on a 5-minute chart, we're just watching this action, and this is just me drawing things play out, right? So we're just watching, right? So this is where the steep decline started. Now we're getting into levels where we are retesting these strong areas of demand. So what we look for is for those levels to be retested, and we want reactions from them, right? So now we don't quite get one today. What we do get is a quick little double bottom trade here. So now, okay, very steep sell-off coming into the open. Almost quite touched it. We see that we gapped up from this area, right? So when we sell, so we know there's still demand here. There's still buyers at this level. That's a huge gap from that level. Now, right here at market open, we sell off straight into it. And then this is the candle that happens over the next 15 minutes. 1, 2. As soon as we cross the high of this candle, we get this trade. And I like to use the VWAP because this is a good target one, right? So this is our risk. Now, my next target is VWAP. That's about 2 times away what I'm risking. And then following that, I'm going to have another target around here at this open. And then my final target will probably be way up here, but it probably won't get hit because this is super far away. But what we do get is, boom, there's target 1, we hit it. Target 2 is here, remember, high this market range, and we hit that as well. And then after that, we're done, right? Because we end up making several series of lows. We recross that, and then we cross below VWAP. So there's so many reasons to exit here. We're done. But what we end up making off of this one single trade, just by being patient, is a 428 entry, 428.60 entry. Target 1 at 430.60, that's $2 there, and then target 2 at 432.40, so almost $4 on SPY. So that's about a $400 options play right there, or $200 options play, and you didn't do anything except find a spot on a chart that price reacted from very strongly. And that's basically the entire premise behind supply and demand trading, is that you look for places on a chart where buyers and sellers create strong reactive price action, and then you just wait patiently until price comes back to that location that you've had strong reactive price action, and you see what happens. So 3-candle reversal pattern. Okay, there's a reaction. We can jump in here, risk below. You don't want to take day trading, right, your risk all the way down here below this, right? You have to be strategic in this because you know that your first target's VWAP. You don't want to take risk of $3 or $4 when you're only going to get $2 in profit, right? So you have to be a little selective here, right? Because it may sell off all the way down to the bottom of demand. It may react the second it touches demand, right? So you have to wait for that reaction to find this, and that's what you get. It doesn't always work out, but it does work out more often than not. So let's do some more examples here. Right here, you have another strong location of demand, right? So this day was December the 1st. Right at the end of day, you create this very strong price rally on the hourly chart, and you also create a very strong level of supply here as well. See the huge sell-off here off of this base, and if you're looking at this, it doesn't quite fill all the way to that next level until the following day. But what you do get from this level is a move all the way down to the exact same location, and a move from 449 to VWAP at 453. That's a really good trade. And you might even get to hold one until tomorrow, just kind of see what happens, and then you get 460. So it's a very simple concept, right? But it's also a very powerful concept, and it is my favorite way to trade. And this happens any stock, doesn't matter what it is. Here's another one. Very strong location, price location for strong rally, and this one actually works out twice. So right there's the base, tested once, tested twice, exact same trade both times. There's the first time, and this is where you start trading. Trade from 426 to 434, and then I trade from 426 to 434. It's the same trade twice. I would argue that the first test is going to be the strongest. The second test you have to be more cautious, and then of course the third test you probably want to wait for some fresh levels, right? Because the more times the level is tested, the more likely it is to fail, right? But it's a very simple style of trading, and it's also, I don't know, it's just, it's kind of my thing, right? But if you also notice in an overall uptrend, like this is obviously overall trending up, you get sometimes what these excess price moves that kind of pop below and then pop right back up. But if you're using your levels, you notice that these levels are excess price, but you're in an overall context of an uptrend. The risk here is that that trend is reversing, but you do have a high probability location, strong rally from this location, 435, and then you create strong supply at 440, 441-ish, and then from that level, you're in an overall uptrend. You get that move from 436 to 441, which is almost exactly this supply level here before it starts to reverse again. And like I said, any ticker, doesn't matter which one. If we go to all the way back here to the dawn of time, right, on any ticker, these levels are going to print over and over and over and over and over again. Look, demand level here, previous market structure here, exact same levels, right, almost. Overall context of an uptrend, and trade from 137 to 153. Actually, in this scenario, you would have had this supply level that was created, so you'd even get more than that if you were being very liberal, I guess, with your price targets. Me personally, I would have taken a target somewhere in here, probably this pivot or even this level here. But this is daily chart. You can swing trade with this. Here's another one. Strong price rally. Strong price rally. Here's some more. Strong price rally. Here, a little mini supply, mini demand level here. Mini demand level here. This one doesn't quite give you the targets you would expect, but if you are being actually like conservative, right, what you see is this is the other setup we talked about: a steep decline, base, steep decline. And if you're looking at the overall context in the shorter term, this is in the context of some bearish price action. So if you take this trade, it's contrary, right? Because you're channeling sideways. This is kind of the whole little sideways channel. You're not quite trending, but near term, you've sort of created some bearish action here. But what you get is this, and this one is easy to miss because it's sort of a mini setup, right? You get the decline into this base, into these two really bearish days, and you look where the rally starts and ends. It's right here at this base, and then pop down into this level here before you actually see any significant bullish reaction, right? So, but you know, you're not going to catch all of this stuff, and you miss them all the time, and it just happens. It's no big deal, right? And you have to look at overall context for sure, right? So overall context in this scenario here is a strong upwards trending market. So what you get is these bullish setups that are going to follow through harder than the bearish setups are going to follow through better. So here, when you create these levels, and sometimes they won't even create, sometimes you'll have to kind of improvise and take your smaller time frame levels. But here, I can tell you on an hourly chart right out of the gate that this is going to create a strong hourly level because of that huge pin bar candle. So I'm just gonna poof, right? So you could take this trade on an hourly chart and it still be a good trade, and this would create a strong base on a hourly chart here as well for a bearish decline. So this would be a target, and then what you can get is a 112 to 114 trade, which is good. It's a good trade. So, and it's any time frame, like I said, and it works very well day trading because you have very clearly defined risk, and you have very clearly defined entries and very clearly defined exits, right? So gaps also create strong levels a lot of the time. Sometimes, like I said, it just trades right through, and that's fine. You miss some of them and you take losses. It's just, you know, it's part of it. But this right here, if I had to pick one strategy to trade for the rest of my career, this is the one. Anyway, I hope that this helps you guys to kind of understand supply and demand trading a little better. And if you have any questions or comments, please leave them below. I look forward to hearing from you. And don't forget to smash the subscribe button. We will see you all in the next one. Cheers.